So as you can see from the document camera that we're doing the number 3 FRQ, I think this is 2018. I'll have to double check that here in a bit, but the question says the United States and South Korea are trading partners and the United States has a 0 current account balance. Assume now that inflation rate of the United States decreases relative to the inflation rate in South Korea. Now, this is a weird question, and so they tell us right off the bat that our current account balance is 0. And so current account, I'm just going to write this down so that we have it in our head. The current account balance currently equals 0. This is significant because this means that we don't have a deficit or a surplus, which is invariably what they're going to ask as we go forward. Letter A then says, based on the decreased inflation in the United States, will the U.S. exports to South Korea increase or decrease? And so inflation in the United States is going down. And so just to remember what that looks like, we have our short run aggregate supply graph here. And what they're saying is that prices are up in Japan. And so at common sense time, Japan price is up. And for the same items, USA price is down. What does this mean? Well, that means the Japanese people are going to want to start buying American stuff because our stuff is cheaper. And so for letter A, it says, based on the decrease in inflation in the U.S., will the U.S. exports to South Korea increase or decrease? If this happens, that means our net exports are going to increase. And so this is your answer to letter A. The net exports increase. Letter B then says, based on the change of exports in Part A, answer each of the following. Will the U.S. current account balance remain at 0, be surplus, or be deficit? So remember what current account is. This is goods and services. And in our examples, we specifically said this means exports and imports. And so if we started at a balance of 0 and our exports went up, that means then that our current account balance is going to get a credit, which means it's now going to be in surplus because it started at 0. Letter B then says, what will happen to the real GDP in the USA in the short run? Explain. Okay. And so B1 was current account plus, and B2 is saying what's going to happen to the USA real GDP in the short run. This is easy. Remember, C plus I plus G plus NX, right? This equals the GDP. GDP or Y1 equals this. If this gets bigger, that means the real GDP gets bigger. So in the end, real GDP is going to go up. We could even graph it if we wanted to. And that's going to, the increase in exports is going to do this. Now, they didn't ask for that, but you could. And then you could see in the short run that our output increased like so. Remember, this is real GDP right there. All right. And now finally, the third question then says, the South Korean currency is the won. Draw a correctable graph of the foreign exchange market for the US dollar. Show the effect of the lower inflation rate in the United States on the won price per dollar. Okay. So here we go. They want the graph for the US dollar. And so if we're graphing the US dollar, that means then that we have demand and supply. Over here, remember, this is won per dollar. And down here, this is quantity of dollars. This is the current rate. And this is, I'm going to change that to R. And this is our current quantity. And it says the U.S. currency, or sorry, the South Korean currency is the won. Draw a correct label graph of the label for foreign exchange market for the U.S. dollar. Show the effect of the lower inflation rate on the United States and the won in price per dollar. Okay. So what all this means is that if the Japanese, and I said Japan at the beginning of this problem, this was South Korea. If the South Korean prices are up and the USA prices are down, then that means the Korean people are going to want to buy American stuff. In order to buy our stuff, they have to convert their currency to American dollars. Remember, our reasons for shifting currency exchange are what we call DIPI. And so DI, PI, these were our reasons. And so we have demand for American goods. We have income of the people looking to buy, price level, and then interest rates. And so these are the things that affect the US dollar. And And so if the price of our stuff goes down, people are going to want to buy it on the international level. And that means then that our currency is going to appreciate. So the US dollar is going to appreciate like so. There's your new demand. There's the new exchange rate. That's what they wanted to show. They said show the increased yuan per dollar, and then there's quantity too. And ladies and gentlemen, this is the answer to letter C on that FRQ that we're showing you there. And so this is a full FRQ from, I think, the 2018 AP exam, and it covered current account, it covered exchange rates, and it asked about GDP as it's affected by this. And that's how these usually go.